Thank you for joining me. I'm Alex, and I want to talk about Shopify. So what they do is they mostly facilitate online shopping, which means that you can create an online store on their platform and they host it and they help with creating the site and everything. And it's actually reasonably simple, and they kind of give a template on everything that you need to do to set up an online store to where you can make everything work, including accepting payments and just about everything else. So if you want to create a new online store, that's a very good solution, and you don't have to host your own stuff and worry about software and everything. So definitely a good business model here, I think. Current price is $931.83, which gives them a market cap of $112 billion. Dividend is zero. I don't expect that to change, and I definitely would not count on it. Revenue $1.6 billion, which is up 50% from the previous year, and that is up over 50% from the year before that. So you have a consistent revenue growth of about 50% here, which is pretty amazing. Earnings negative $125 million, which is down from negative $65 million, which I don't think they've ever made a profit, and obviously that's not the goal. So currently they have a PE of negative 1,606, which means that they would be reasonably close to being profitable. I have a problem with the valuation more than anything, because obviously losing $125 million on revenue of $1.6 billion is not close to profitable. Forward P of 400 means that they're forecasted to be profitable, and the next year or the year after the current year, they're actually forecasted to have a pretty decent PE. I'm not sure if I believe that, and I'm not sure if they intend that, though. If I were them, I would mostly invest in growing and be close to break even, probably. Depending on how easy it is to get money and how cheap it is to get money. Total assets $3.5 billion, total liabilities $474 million, which gives them a total stockholders' equity of $3 billion, and that is a nice balance sheet. Now, obviously, it's not a great balance sheet considering the market cap of $112 billion, but the ratio of assets to liabilities is even a tad high. So good balance sheet. Now, the valuation is the point that I kind of have a problem with. The revenue is $1.6 billion and the market cap is $112 billion, or almost 100 times their sales. If they wanted to get to a reasonable PE, they would have to increase their revenue about 100-fold and then have a margin of about 75%. And I don't really see that happening anytime soon. Now, increasing their revenue 100-fold is not actually that hard considering the growth of 50%, which means the doubling of the business every, 2.25-ish times in 2 years. So it's not too far in the future if they keep going at the current pace. But still, I think the company is way overvalued, and you would still have to wait about a decade for a decent valuation, even at those numbers. So I think that even as a growth stock, it's way overvalued, and so I definitely wouldn't buy it. Obviously, no dividend, so a dividend investor wouldn't want to buy this either. And a value investor, negative earnings is one huge red flag, and PE of 400 is also definitely not for a value investor. So overall, I don't recommend this stock to anyone at this time. If they could even accelerate the growth, which seems difficult at a current pace of 50%, then it might be worth it at some point. But still, I wouldn't want to wait like 10 years for them to have a decent valuation. If I buy a growth stock, I kind of want to see a decent-ish valuation in 5 years' time at current growth rates, and that is definitely not the case here. So that's it for me for today. If you like this video, make sure to subscribe. I'm coming out with more videos every day before market open. I hope you have a successful day.